At age 50, Linda owns a business that collects $130,000 a year, but after the business pays its operating costs, it leaves Linda $44,000 before income and self-employment taxes. She works 3,000 hours a year. That is $14.67 of owner earnings per hour. Her company looks successful from the outside. Inside, it is consuming the time she needs to protect the next 17 years. Linda has $7,500 in cash, $18,000 in retirement savings, and a current retirement contribution of $200 a month. Age 67 is 17 years away. This did not happen because Linda is lazy. It did not happen because she lacks ambition. And it did not happen because she failed to discover one more productivity trick. It happened because her business shows revenue clearly while hiding the cost of complexity. That mechanism has a name: the complexity tax. This is not a government levy. It is the money, capacity, and future funding lost when a business adds clients, services, tools, and decisions faster than it adds a system for measuring them. In Linda's agency, the tax operates through three mechanisms: margin mix blind-spot, context switch toll, and retirement last routing. The blockers are just as specific: a contribution map, a capacity firewall, and an owner future route. Linda is a fictional composite, and every number that follows is an educational illustration. The business result is not a forecast. The retirement result is not a guarantee. Tax, legal, worker classification, and retirement plan decisions require Linda's actual records and qualified guidance. Start with a ledger. Linda's marketing agency in Richmond, Virginia, collects $130,000 in annual gross receipts. Contractor and pass-through delivery costs consume $47,000. 14 software subscriptions cost $847 a month, or $10,164 a year. Other business expenses consume $28,836. Subtract those three categories from gross receipts: $130,000 minus $47,000 minus $10,164 minus $28,836. $44,000 remain as owner earnings before tax. Now divide $44,000 by 3,000 working hours, $14.67 per hour. That figure does not say Linda's business is worthless. It says the top line and the owner's return are answering different questions. Her simplified personal snapshot is also narrow: $7,500 in cash, plus $18,000 in retirement savings, equals $25,500. That is not her complete net worth. It excludes the value of the business, personal debts, taxes due, equipment, home equity, insurance, and every obligation not listed. But it makes the runway visible. 17 years, $25,500 in the simplified snapshot, $200 a month going toward retirement. Now the first mechanism becomes dangerous: margin mix blind spot. Linda has 25 active clients and 7 service lines. Her accounting system tells her what each client was billed. It does not reliably show what each client contributed after direct delivery cost and owner time. 10 clients produce $22,000 in collected revenue. Those 10 clients require $14,000 of contractor and pass-through cost. The contribution left before shared overhead is $8,000. They also consume 1,000 hours of Linda's year through delivery, revision, communication, and administration. $8,000 divided by 1,000 owner hours is $8 of contribution per owner hour before shared overhead. That is not an $8,000 loss. The clients are contribution positive, and the 1,000 hours are not cash sitting in a hidden account. This distinction matters. The old version of this story combined uncaptured pricing, administrative time, and software cost into one enormous tax total. That arithmetic counted different categories as though each were cash already available to Linda. The honest version keeps 3 ledgers separate: direct cash cost, capacity currently occupied, and future value understated assumptions. The U.S. Small Business Administration describes contribution margin as the difference between price and variable cost. It also notes that products or services with different economics may need to be calculated individually. That is Linda's first blocker: the contribution map. For every client, she records 6 facts: collected revenue, direct delivery cost, owner delivery hours, owner administration hours, contribution dollars, and contribution per owner hour. She also marks payment delay and any contractual exit obligation, because a profitable invoice that arrives late can still create pressure. The map does not tell Linda to fire the smallest client. It tells her which relationship needs a price change, a scope change, a process change, or a respectful exit. The viewer is not the problem. The missing unit economics are the problem. The contribution map blocks margin mix blind spot, but a clear map will not stop the second mechanism by itself. Context switch toll. Linda's 7 services create 7 different production systems. Her 25 clients bring different approval rules, channels, deadlines, and revision habits. Her 14 software tools each add a renewal, login, workflow, data location, and failure point. None of those items is automatically wasteful. The tax appears when each addition looks reasonable alone, while the combined switching burden remains unmeasured. Laboratory research on task switching has found measurable switching time costs, and those costs can rise as task rules become more complex. That finding does not prove Linda loses a universal percentage of every day. It does not convert distraction into an invented dollar figure. It supports a narrower conclusion. Switching is not free. Linda's direct tool audit finds that 9 subscriptions duplicate functions she already has or support services she no longer wants to sell. Those 9 tools cost $535 a month. 535 multiplied by 12 equals $6,420 a year. That is measurable cash. The 1,000 hours attached to the 10 low contribution clients are different. They become valuable only if Linda can remove the work and use the release time intentionally. That is why the second blocker is a capacity firewall. Before Linda accepts a new client, service, or tool, it must pass 5 gates: defined scope, explicit price, estimated direct cost, named owner hours, and a clear source for the capacity it will consume. If the new commitment has no capacity source, it does not enter the system yet. Berkshire Hathaway's published acquisition criteria provide a useful analogy. Berkshire asks for understandable operations, demonstrated earning power, management already in place, and an offering price. It also says it does not want to waste either side's time when the price is unknown. Linda is not Berkshire, and this is not a command to copy an investing company. The transferable discipline is simpler. Define what the business understands, what it earns, who owns the work, and what the price is before saying yes. For existing commitments, Linda does not cancel contracts overnight. She reviews termination terms, finishes promised work, protects client files, exports required records, checks data security obligations, and creates a staged 90-day transition. The capacity firewall blocks context switch toll without turning clients or contractors into the enemy. Now comes the mechanism that connects a busy business to late retirement start. Retirement last routing. Software renewals run automatically. Contractor invoices have due dates. Client emergencies create urgency. Linda's retirement contribution receives whatever is left. The business does not need bad intentions. The urgent routes simply operate before the future route. At $200 a month, beginning with $18,000, a fixed 5% illustration over 17 years reaches approximately $106,144. At 7%, it reaches approximately $136,988. Those are scale illustrations before fees and taxes. Returns fluctuate. Contributions can stop. Account rules matter. Now test a simplification scenario without pretending it is guaranteed. Linda stages an exit from 10 low contribution clients. Revenue falls by $22,000. Direct delivery cost falls by $14,000. Owner earnings therefore fall by $8,000 before shared overhead changes. 1,000 owner hours are released. She cancels 9 unnecessary tools and saves $6,420 a year. Then she sells only 300 of the released hours in her core service at $85 an hour. 300 multiplied by 85 equals $25,500 in modeled new receipts. The scenario assumes those hours are sold and collected, require no new direct cost, and do not require replacement software. Real results can be lower, higher, delayed, or negative. Under those fixed assumptions, owner earnings move from $44,000 to $67,920. The equation is 44,000 minus 8,000 plus 6,420 plus 25,500. Modeled working time moves from 3,000 hours to 2,300 hours. Across 50 working weeks, that is 46 hours a week. Modeled owner earnings per hour become approximately $29.53. Again, this is a scenario, not a promise. The value of subtraction appears only after released capacity is actually removed, protected, and redeployed. Now Linda builds the third blocker, the owner future route. Before adding another tool or service, the business calendar assigns money to taxes, an operating reserve, and retirement under verified rules. In this illustration, Linda tests a monthly equivalent retirement target of $1,000 instead of $200. That is an additional $800 a month, or $9,600 a year. She cannot simply label the whole amount an individual retirement account contribution. For 2026, the IRS states that the individual retirement account limit is $7,500, plus a $1,100 catch-up for someone age 50 or older. Other small business arrangements, including SEP, simple, and qualified plans, follow different contribution, employee coverage, compensation, and filing rules. Linda has contractors in this illustration, but actual worker classification must be verified. A label in a spreadsheet does not determine legal status, so the $1,000 monthly figure is a cash flow target. The actual account, contribution schedule, tax treatment, and permissible amount must be confirmed with current IRS rules, plan documents, and a qualified professional. With $18,000 initially and $1,000 a month for 17 years, the 5% illustration reaches approximately $362,564. At 7%, it reaches approximately $449,089. Compared with the $200 path, the model difference is approximately $256,420 at 5%. At 7%, the model difference is approximately $312,101. Those differences are not the complexity tax in cash. They are future value illustrations created by an additional $800 a month under constant return and monthly compounding assumptions. Investor.gov provides the same core inputs: initial investment, monthly contribution, time, estimated rate, and compounding frequency. The word estimated matters, and age 67 is a planning marker, not an instruction to stop working or claim a benefit. Under current Social Security law, full retirement age is 67 for people born in 1960 or later. Linda still needs her own Social Security record and her own claiming analysis. Now the story is no longer about doing less because a billionaire said no. It is about making the economics of every yes visible. Margin mix Blindspot was blocked by a contribution map. Context switch toll was blocked by a capacity firewall. Retirement last routing was blocked by an owner future route. If you are between 38 and 52 and your work looks successful while your future remains underfunded, create 3 files this week. File 1 is the contribution map. List collected revenue, direct cost, owner delivery hours, owner administration hours, contribution dollars, and contribution per owner hour for every client or project. File 2 is the capacity firewall. Write the 5 gates for every new commitment: scope, price, direct cost, owner hours, and capacity source. File 3 is the owner future route. Verify taxes, reserve needs, worker status, retirement plan rules, and the exact destination of the next dollar before the month begins. Do not copy Linda's dollars. Copy the logic. Separate cash cost from occupied capacity. Test the scenario. Verify the rules. Root the future before complexity consumes it. The next invisible tax hides inside hard work itself. It rewards visible effort, consumes private assets, and can leave a disciplined worker with nothing to show for years of motion. That mechanism is next.